It wasn't a coincidence. It wasn't a glitch in the data. It wasn't even a conspiracy of silence. It was a calculation, a cold, dispassionate assessment of risk. When the smart money moves, it does not announce its departure. It does not ring a bell at the top. It does not hold a press conference to explain why it is selling the very assets it told you to buy. It simply leaves quietly, efficiently, and completely. We see the headlines today: CEOs liquidating record amounts of stock, founders stepping down from the empires they built, massive purchases of farmland, gold, and bunkers in remote jurisdictions. The media calls it diversification. They call it estate planning. They call it a lifestyle change. But if you look at the ledger of history, you see something else entirely. You see a pattern that has preceded nearly every major currency collapse and financial reset in the last 300 years. The incentives are clear. The arithmetic is merciless, and the timeline is contracting. This isn't prophecy. It's positioning under constraints. To understand what is happening right now, we must look at the playbook used by the ultra-wealthy in the moments before the music stopped in the past. We have 3 specific case files that reveal the mechanics of the exit. These are not theoretical models. These are historical events where fortunes were either obliterated or multiplied, depending entirely on 3 specific moves. Case file 1 takes us to the heart of Europe 1 century ago. The Weimar Republic, Germany, 1919. Most history books tell you about the wheelbarrows of cash. They tell you about the hyperinflation that destroyed the middle class, but they rarely tell you about the men who became the richest individuals in the world during that exact same period. While the currency was collapsing, a specific group of industrialists was executing a strategy that seems counterintuitive, yet was mathematically perfect. The central figure in this drama was Hugo Stinnes. They called him the Inflation King. In 1919, Stinnes looked at the balance sheet of the German state. He saw the war debts. He saw the reparations demanded by the Allies. He saw a government that was too weak to tax its citizens and too terrified to cut spending. He knew with absolute certainty that the government had only one option left. They would print the mark into oblivion, while the average German citizen was dutifully saving money in government bonds, believing in the patriotic duty to hold the currency. Stinnes did the opposite. He executed the first great move of the capital preservation playbook. He leveraged up. He borrowed massive amounts of German marks, millions, eventually billions, from the very banks that were creating them. But he didn't hold the cash the moment the loan was approved. He exchanged the paper currency for hard, tangible assets. Coal mines, steel mills, shipping fleets, hotels, newspapers. Think about the mechanics of this trade. Stinnes borrows 1 million marks in 1919. With that money, he buys a coal mine. By 1921, the inflation is raging. The value of the mark has collapsed by 90%, but the value of the coal mine priced in real terms has remained steady or increased more. Importantly, the debt he owes is still denominated in the old worthless marks. He could sell a single ton of coal, pay off the entire debt that bought the mine, and keep the asset free and clear. He was effectively shorting the currency and going long on reality. The middle class, the pensioners, the people who held cash and bonds, they were wiped out. Their savings evaporated. A lifetime of labor was reduced to the price of a cup of coffee. But Stinnes and those who followed his strategy ended up owning a significant percentage of the entire German economy. The incentive was not greed. The incentive was survival. Under the constraints of a dying currency, debt denominated in that currency becomes an asset provided you use it to buy things that cannot be printed. This brings us to case file 2, the United States 1928 and 1929. The Roaring Twenties. A different kind of crisis, but the same underlying signal. The currency wasn't collapsing through inflation, yet the financial system was collapsing through leverage. The stock market was the only game in town. Shoeshine boys were giving stock tips. Taxi drivers were trading on margin. The narrative was permanent prosperity. Economists declared that stocks had reached a permanently high plateau. Enter Joseph Kennedy, the father of the future president, And a man with a ruthless instinct for market mechanics, Kennedy, saw the same euphoria that everyone else saw, but he also saw the leverage. He saw that the entire market was built on borrowed money. He knew that when the selling started, the liquidity would vanish instantly. The constraint here was not inflation, but liquidity. In a crash, you don't sell what you want to sell. You sell what you can sell, and usually you sell it at a loss. So Kennedy executed the second great move, the liquidity extraction. While the public was piling into the market, taking out loans to buy RCA and General Motors, Kennedy was selling. He wasn't just diversifying. He was exiting. He moved into cash. He moved into gold. He moved into government bonds, which at that time were a safe haven against the coming deflation. Legend has it that Kennedy decided to sell everything the day a shoeshine boy gave him a stock tip. He realized that if the person with the least capital and the least information was fully invested, there was no one left to buy when the crash came in October 1929. It was brutal. Fortunes that had taken decades to build vanished in hours. Men who were millionaires on Monday were destitute by Friday, but Kennedy was sitting on a mountain of cash. And in a deflationary depression, cash is king. As asset prices collapsed, real estate company stocks falling 80 or 90%, Kennedy stepped back in. He used the cash he had preserved to buy the wreckage of the American economy for pennies on the dollar. He didn't predict the exact day of the crash. He simply looked at the structural instability and positioned himself outside the blast radius. The payoff for being early was survival. The penalty for being late was ruin. Case file 3 moves us to the 1970s, the era of the Great Inflation, the breakdown of the Bretton Woods system. For decades, the global financial system had been anchored to gold. But in 1971, an anchor was cut. The U.S. dollar became a fiat currency backed by nothing but faith. Inflation began to climb. Oil prices skyrocketed. The stock market, which had been the darling of the 1950s and 60s, entered a lost decade. Adjusted for inflation, the stock market lost nearly 70% of its value between 1966 and 1982. Here, the smart money executed the third great move, the rotation to tangibles. The Hunt brothers are the famous example trying to corner the silver market. But look at the broader behavior of the elite class during this decade. They abandoned the nifty 50 stocks, the high-flying tech and consumer companies of the day. They moved capital into farmland. They moved into commercial real estate. They moved into commodities. They moved into art and collectibles. Why? Because when a currency is losing purchasing power at 10 or 15% a year, a bond paying 5% is a guaranteed loss. A stock with stagnant earnings is a trap. The constraint was negative real yields. The incentive was to hold assets that had intrinsic utility. Farmland produces food, regardless of the price of the dollar. Oil powers machines, regardless of the Fed's interest rate. Gold preserves purchasing power, regardless of the government's deficit. By the time the inflation peaked in 1980, those who had stayed in traditional 60/40ths portfolios had been decimated in real terms. Those who had rotated into tangibles had preserved their wealth. Now we must overlay these 3 historical moves onto the present day. The pattern is unmistakable. We are seeing a convergence of all 3 signals simultaneously. First, look at the selling. The liquidity extraction is happening at a scale we have never seen. In the last 24 months, corporate insiders, the people who know the real health of their companies better than any analyst, have been selling stock at a record pace. The ratio of insider selling to insider buying is at historic highs. The founders of the largest technology companies in the world are cashing out billions of dollars. They are not reinvesting in the market. They are taking chips off the table. Just like Kennedy in 1928, they are building a fortress of liquidity. Second, look at where that money is going. It is the rotation to tangibles. We are witnessing the greatest consolidation of farmland in history. Billionaires who made their fortunes in software and logistics are suddenly becoming the largest landowners in the United States. They are buying hundreds of acres, thousands of acres of productive soil. Why? Because they know that in a currency Reset digital wealth is ephemeral. Land is permanent. You cannot print an acre of soil. You cannot inflate away the value of a water right. This is the Steen's strategy adapted for the 21st century. They are trading overvalued paper assets for undervalued real assets. Third, look at the debt. The governments of the developed world are in a position that mirrors the Weimar Republic, not in speed, but in structure. Debt to GDP ratios are over 100%. Interest payments on that debt are consuming the entire tax revenue. The central banks are trapped. If they raise rates to fight inflation, they bankrupt the government. If they lower rates to save the government, they destroy the currency. The smart money knows there is only one way out of this trap. Financial repression, inflation, currency debasement. This explains the third move we are seeing today, the jurisdictional hedge. The purchase of second passports. The acquisition of bolt-hole properties in New Zealand, South America, and remote islands. The construction of high-end bunkers. This is not paranoia. It is the recognition of political risk. When the currency fails, the social contract breaks. When the middle class realizes they have been priced out of existence, politics becomes volatile, populism rises. Wealth confiscation becomes a popular policy. Capital controls are imposed. The billionaires are not just hedging against market risk, they are hedging against you. They are hedging against the inevitable reaction of a society that realizes it has been looted. The constraint engine driving these moves is simple. It is the realization that the current financial cycle has reached its mathematical limit. You cannot solve a debt crisis with more debt. You cannot solve an inflation crisis by printing money. The system requires a reset, and the people who own the system are preparing for it. Most observers agree that we are currently in the late stages of this cycle. The warning signs are flashing. The volatility in the bond market, the erratic behavior of commodity prices, the desperation of central bank policy, but there is always a counter-argument. The mainstream view is that technology will save us. They argue that AI will create a productivity boom that will grow us out of debt. They argue that the dollar has no rival, so it cannot collapse. They argue that the central banks have learned from history and can manage a soft landing. This optimism ignores the incentives. Technology is deflationary, yes, but the debt is inflationary, and the political will to cut spending does not exist. Incentive for the politician is to kick the can down the road. The incentive for the central banker is to protect the banking system, not your savings. The incentive for the billionaire is to exit before the door closes. Betting on a soft landing requires you to believe that a group of bureaucrats can manage a chaotic, complex system perfectly despite having failed to do so in every previous cycle. The arithmetic suggests otherwise. We are moving toward one of three endgames. History shows us the menu. There are no other options. The first endgame is controlled decline. This is the British Empire model after World War II. Decades of austerity, currency devaluation, capital controls. A slow grinding reduction in the standard of living. The empire retreats. The currency loses its reserve status gradually. Life becomes harder, more expensive, and less free, but the system survives in a diminished form. For the unprepared, this is a slow suffocation of wealth. For the prepared, it is a manageable transition. The second endgame is chaotic collapse. This is the Soviet Union in 1991 or Zimbabwe in 2008. The system snaps, hyperinflation destroys the currency in months. Supply chains break, store shelves go empty. The political structure disintegrates. In this scenario, paper wealth goes to zero. Stocks, bonds, bank deposits, they all become worthless. Only those holding physical assets, gold, land, and foreign currency survive. This is the scenario the bunkers are built for. The third endgame is reset and restructure. This is 1944. Bretton Woods, or the introduction of the Rentenmark in Germany in 1923. The powers that be acknowledge. The old system is broken. They convene a conference. They introduce a new currency, perhaps digital, perhaps backed by a basket of commodities. They revalue gold. They wipe out the old debts and the old savings along with them. The system restarts, but the rules have changed. Wealth is not destroyed, but it is transferred. It is transferred from the creditors to the debtors, from the savers to the asset holders. In all three scenarios, the winner is the one who holds the claim on the real world, not the claim on the government. The loser is the one who trusted the promise on the paper. The pattern is repeating. The insiders have sold. The land has been bought. The laws are being written. The trap is being set. It is not a matter of if, it is a matter of when. The only variable is timing and pain. If you are not paying attention to the flow of capital, you are the liquidity. If you are not watching the exits, you will be trapped in the burning theater. Billionaires have made their three moves: liquidity extraction, asset rotation, jurisdictional hedging. They are positioned. The question is, are you? Subscribe to this channel. We do not give financial advice.